Around this time last year, I was at my wit's end. I had been dealing with a toothache on my lower jaw, left jaw, for nearly a month. What started as a slight pain, I bite into something, became the most intense pain that gave me sleepless nights. Finally, I went to the dentist who, after examination, told me my tooth was severely infected and I needed a root canal. So he set me up with an endodontist, and a few days later I had the procedure done on my tooth. I felt way better once it was healed, and at least physically. Mentally though, I was upset about spending almost $2,000 from my pocket since my health insurance didn't cover most of the dental service. This isn't money I had lying around waiting to pay for a dental procedure. I had plans for it, so I started thinking, what if I have a separate savings account for emergencies such as this? Turns out there is such a plan, and it comes with benefits beyond cushioning you for out-of-pocket medical expenses. I'm talking about the Health Savings Account, otherwise known as the HSA. The HSA is a type of savings account that lets you put aside pre-tax dollars regularly to pay for your qualified medical expenses. Basically, you can put your money away in this account from your gross income and take it out when you need it without paying a dime to the IRS. That's as long as you're using it for specific expenses like deductibles, co-payments, co-insurance, dental services, psychological therapy, psychiatric care, ambulance costs, acupuncture, and qualified long-term care services, just to name a few. However, you want to keep in mind that you can't use your HSA savings to pay for your insurance premiums, as they don't meet the criteria of qualified medical expenses. So how does the HSA work and who is eligible? But before we talk about how this plan functions, I like to point out that not everyone qualifies. Basically, to be eligible for HSA as of 2024, you have to meet these 4 criteria. Number 1 is you must be enrolled in a qualified high deductible health plan, also known as HDHP, on the first day of the month. Now, if you don't know, HDHP is a plan that comes with a higher deductible than traditional insurance plans. A deductible is the amount you pay out of pocket before your insurance coverage kicks in. Since the deductible is higher, the monthly premium is usually lower with HDHPs. Number 2 is you can't be enrolled in Medicare or TRICARE. If you already had HSA before you enrolled in Medicare, you can still withdraw your savings tax-free for qualified medical expenses. You just can't contribute tax-free money anymore. Number 3 is you must not be listed as a dependent on someone else's tax return. And number 4 is you can't have any other health coverage. Now, even if you have HDHP, I'd recommend asking if it is HSA deductible before taking the next step. That said, there are 2 ways you can set up your HSA. The first is through your employer, in which case you want to reach out to your HR for advice on setting up that account. However, if your employer doesn't offer it, or maybe you're a self-employed business owner or freelancer, you can set up the account yourself with a financial institution that offers it. There's no shortage of HSA providers in this country, each with its own set of terms. Registration is pretty straightforward. You'll need to provide important details such as social security number, ID or driver's license, employer information if relevant, contact details, and any signatures you might want on the account. Once it's set up, you can start making your contributions. As of 2024, you can contribute up to $4,150 for self-only coverage, or $8,300 if it's family coverage from your income before tax. This is expected to increase to $4,300 and $8,550 respectively in 2025. However, if you're 55 years or older, you can save an additional $1,000 as a catch-up contribution. These savings are then invested in different assets depending on your chosen HSA provider, and whatever you don't withdraw continues to accumulate into the future. This brings us to the flexible benefits that HSAs come with. Let's start with contributions. You can contribute as little or as much as you want, as long as you don't exceed the annual limit. If you find that you have gone over the limit, you can correct it before tax filing deadline to avoid any penalties. The best part though is that unlike a flexible spending account, you don't lose your unused contributions when the year ends. You simply carry them forward. However, keep in mind that you can only contribute cash unless it's an employer-sponsored account. Withdrawals, when it comes to withdrawals, there's really no limit to how much you can withdraw as long as the medical expenses qualify. That means if you have saved quite a bit, you don't have to worry about digging further into your pocket in case of an emergency. Even better, you can withdraw your money tax-free. You also have investments. So what happens to your savings when they are in an HSA? You can invest them. That's right, you can choose where you want your money invested, whether in stocks, bonds, ETFs, mutual funds, and so on. Once you pick what you want, most HSAs will automatically rebalance for you. All in all, this flexibility allows you to save for medical expenses, grow those savings while you wait to use them, and more importantly, pay for the medical costs when you want. So is an HSA worth having? Of course, definitely. Here are 3 reasons why you need an HSA account. Number 1, it starts with the triple tax benefits. When it comes to tax benefits, few if any investment plans out there come close to an HSA account. First, you can contribute from your pre-tax income, which lowers your taxable income and consequently your tax bill. Even if you contribute from your after-tax dollars, you can claim the contribution as a deductible on your tax returns. Second, your contributions get to grow tax-free. That means you can invest your savings and earn tax-free gains or interest. And third, you can withdraw your money, including gains tax-free, to pay for qualified medical expenses, a triple win. Number 2 is long-term savings potential. Now, if you're young and healthy, you're probably thinking, I don't need to save for medical expenses beyond my insurance. However, the HSA isn't just about covering expenses for today, tomorrow, next month, or next year. You can save for future medical expenses, which are likely to come as you get older and after retirement. Talking of retirement, once you hit 65 years, you can take out the money for any other reason, not just medical expenses, without a penalty. Basically, it's just like an IRA. Number 3 is portability. Another great reason to have an HSA is you can move with it even if you change jobs. That's because it's attached to you rather than your employer. Such is not the case for an FSA account. But as good as an HSA is, most people don't take it seriously because some of the myths and misconceptions about it. So let's quickly talk about common misconceptions about HSAs. You don't need HSA if you have medical insurance. This is totally false. HSAs reduce out-of-pocket expenses in addition to growing your savings. HSAs are only available through employers. As I mentioned earlier in the video, you can open your HSA by yourself. You have to use your money by the end of the year or else you lose it. You don't actually. This rule only applies to flexible spending accounts. You can only use your HSA for serious medical conditions. Also a myth. In fact, you can pay your procedures otherwise considered cosmetic by health insurance providers. You can't use HSA funds after you enroll in Medicare. This is also untrue. While you can't contribute, you can withdraw funds already in the account for qualified expenses tax-free. You have to use HSA savings for medical costs as soon as they happen. You can actually claim months or years as long as you incurred the expense when you had the HSA account. High deductible health plans are too risky or too expensive. If your medical expenses are generally low, HDHP can be a lot more affordable, plus you get to save for when they do go up. Also, while deductibles are higher than other health covers, there is a maximum limit on how much you will pay out of pocket. This is $7,000 for self-only coverage and $14,000 for family coverage. All in all, HSAs come with several benefits for people of all ages. Remember, you can't predict when a medical emergency will strike. You can only plan for it. And even if you don't use the money for medical expenses, the savings plus compound gains can provide income once you hit retirement. So have you started saving for your future medical expenses? What's your experience with HSAs? Comment below if you enjoy watching, like, and share the video. And for more practical personal finance tips, subscribe and ring the notification bell so that you never miss an upload. See you on the next one.